please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, focusing on the macros now, the Reserve Bank of India will do its first open market operation of 2018 on 17th of May. The Finance Ministry says there will be more OMOs or open market operations from the central bank this year. Bank of America, for example, estimates 1.4 lakh crores of OMO purchases. To find out what is behind the calculations and what will be the impact on the bonds, we have with us Mr. Indranil Sengupta of Bank of America Merrill Lynch. Mr. Sengupta, hi, thanks very much for joining in. So firstly, how much are you expecting in terms of OMOs from the RBI in this fiscal? Can you highlight the math for us?
Well, we are expecting about 1,50,000 crore if oil persists at current levels. But obviously, a lot depends on where oil prices go. But like I said, if it is around current levels, we are expecting 1,50,000 crore.
Okay. How much do you expect yields to soften based on your assumption of open market operations this fiscal then?
Well, we think that OMOs should lead to excess demand in the GSEC market, and that should bring down yields in the second half of the year. We think that 2018 is a bit like 2016, when the RBI did do significant OMOs because FX flows were low, and actually there was almost over 100 basis points rally in yields in that year.
Okay, so can you put some sort of numbers to this? What is the range in yields that you're looking at in the near term?
Hard to set a range for yields right now because there are so many moving parts, but we feel that as inflation comes down, as the RBI OMO picks up in the second half of the year, there could be a fairly strong rally.
Okay, so I guess we're not getting a number from you. But I mean, some indication of to what extent yields could soften, and where do you see a sustainable level for the benchmark, and maybe a time frame?
7% by the end of this year. Especially like I'm saying, in the second half you have inflation, fears proving overdone. You have, the RBI doing more OMO. So, I think the cards are really stacked in the favor of yields in the second half of the year.
Okay. In that context, then, what is your forecast on Brent crude prices by year end as well?
Well, we are looking at oil rolling down towards a 64 average for this year as of now, but there could be a risk to that as well. But if oil persists at current levels, you get more OMO. So, the yield call is actually gets stronger if you have higher oil prices, if you have FX flows coming off, and therefore the RBI does more OMO.
Okay. You're expecting inflation to probably peak off by the second half of the fiscal. What is that predicated on, and what is your exact estimate?
Well, we think inflation will average around 4.2% in the second half of the year. In fact, this April, we are looking at inflation coming to 4.2%. See, there are a couple of base effects in June and in September where inflation will go above 5%. But, given the fact that growth is still fairly weak, given that liquidity is tight, given that we are expecting normal rains, it's hard to have a very, hawkish inflationary outlook, at least from our side.
And for the April, a month itself, the outlook there?
4.2%, a shade below 4.3% last year. Even May should not be too high because food prices are still rolling down in May.
Okay. All right. Well, just staying with inflation, Mr. Sengupta, based on your estimate for inflation, what are you expecting from the Reserve Bank of India in terms of rates?
Well, we have a cut by the RBI on August 1, assuming that rains are normal. If inflation stays the way it does, if the rains are good, we think that, there is every chance that the RBI will cut. because the bulk of their inflation fears will prove to be overdone.
And you're expecting only one rate cut then?
As of now, yes.
And that basically means we're moving to a different policy stance. So you're looking at a rate cut, one rate cut, no chance of tightening at all from the central bank this year?
No, we do not see, given our inflation forecasts, any need to tighten because, in fact, I think even the RBI's forecasts are now close to ours, which is around 4% in terms of inflation. And, then there is hardly any need to tighten. Given that, growth in the second half will slow. I mean, right now, everything will look good. Earnings, growth, credit, because of base effects. In the second half, again, you will see a lot of these numbers come off.